Back with Dennison Hambling this morning from Intelligent Monitoring. Dennison, morning.
Morning, Andrew.
Yeah, good to catch up with you. Quarterly report out this morning. I suppose 2024 so far has been a big year for Intelligent Monitoring, particularly on the acquisition front. Share price recently hit a high of 63 cents. Market cap not looking too bad either, around 185 million. What would you say are some of the key highlights of the year so far?
Look, it's been a really big year for IMG, and I guess it's been built on a couple of big years actually. Going back 2 or 3 years ago when we set the platform and made the investment in our sort of core operating systems. This year's obviously been dominated, notwithstanding the recent acquisitions, by the ADT acquisition in August last year. We don't quite get a full year of ADT, but we get 11 months of it in this year, and it's been a company transforming event for us. As I always like to remind people at this stage, ADT was a turnaround. It was a business improvement exercise, and we've been pretty busy this year getting to work on that. So we're pretty happy. Through the foundation of a lot of hard work, it hasn't been given to us to be rounding out the year in pretty good shape. So we're happy with the quarterly. It's showing the progression that we have been talking about, and we're looking forward to 25.
Well, just on the quarterly itself, what should we be looking for, and how are those numbers looking?
Look, the quarterly to me shows the direction to which we've been talking about the business as we improve ADT, and then as we bulk up. So the first point, I guess, to make right here with this quarterly is that it doesn't include the acquisitions we've just made. So it is a quarterly that reflects the past, not the future. But when you look at it, we've got a $5.2 million quarterly operating cash flow, excluding the costs of the acquisitions and also the integration charges that we've been taking from Johnson Controls from ADT, which cease at the end of July, which puts us on track for a sort of $13 million similarly adjusted number for the full year. 5 million quarterly, sort of the 20 million operating cash flow number, which we continue to say will improve as we continue to improve the quality of the business and what we do in our hands off JCI. So I think that we've been saying this is a really cash generative business. It's been a little hard for people to see. It still is a little bit hard because there has been a lot going on. There is a lot going on in the business, but it is. And I think we can see it, and we feel good about it, and we think that 25 will be a really transformative year in that regard, which we're looking forward to.
Well, what do you look for in making these acquisitions?
Well, I think the one thing, and I like to say to people, I think the only reason that I would be a candidate for this job is I like to think that I'm a fairly focused operator or person. And, we've been very clear, one, about the strategy and where our growth areas are and what those opportunities are. And, I've spoken with you about that a number of times, but around commercial and then the easy install residential and then ADT Care coming along as well. I think, though, that it's also about us really just staying focused on doing the job itself and integrating and actually the delivery of what we do. And so, for me, being very clear about what we do, executing against it, and then looking for scale. So having that clarity, then in a strategy, then you can actually look at opportunity. And, we've said through this is a fragmented market. On each of those 3 strategies, it's under-penetrated, particularly in residential as well. And so you have a situation where organic growth executed properly should be good. Security is clearly in need. We're in a heightened security environment, as has always been, as everyone would be aware of. But also technologies coming to enable different solutions. And so we can both potentially consolidate, as we've been doing, and we can also grow. And so for us, what we're looking for is things that we can digest. And I make the point in this quarterly that we're already very well advanced in integrating the 3 businesses we've settled in the last month. We've been talking with them for long periods of time, some of them, and been working with them for long periods of time too. So they need to be very digestible. I don't want to have an indigestion situation in this business. I'm very aware and alive to what that looks like. And so I'd always say to people, look carefully at where these businesses go with inside our business. They don't just hit the top level group and then bog the entire business down. They're usually very strategic into areas that are sort of self-contained. And then what do they add value? And I mean, we could run around like a chicken and buy a bunch of stuff and then like run for the hills. And I'm sure that there could be people that would do that. I mean, my goal personally is to build something enduring. So, wherever that ends up, or in whatever hands that ends up, history and fate will determine. But, we're trying to build a culture, values, and a business that does a fundamentally good job for its customers, that's enduring in an area that, is in need. And we feel pretty good about where we're at and what we're doing.
Well, look, for a company that's earnings accretive, what kind of multiple can you buy these businesses for?
Well, we haven't bought anything yet in our hands with a multiple above 3.5 times EBITDA. And I think I can't say for sure, but since I've been MD, I think we've done 6 acquisitions of various sizes, obviously with ADT being the biggest, and the ACG acquisition we've just done would be the second. So I say to people though, what we focus on is the earnings in our hands though. Like, what does it do to us? And so there may be situations where it could be highly synergistic, where you could pay a bit more, or they open up growth or whatever. We're really driven by value. We are lucky. I think we can probably largely continue around those metrics as and when things come up. We definitely still see things all the time. I mean, one of the blessings of our business model is we have a wholesale business that deals with a lot of the independent community. And so we actually deal with a lot of the market. We know them and their businesses, such that if they wish to have a discussion or they're looking for solutions for their business too, we're trying to put ourselves up as the natural partner in conversation for them. And so we go, but it will depend. I mean, a little bit depend on the nature of the cash flows, the length of the cash flows. It's about quality, growth, and returns.
You'd think there's some large security firms globally keeping a close watch on what IMB's up to.
Yeah, well, one of I guess the risks in my role and for my team in doing this is we are a listed business, so we will always be at all times vulnerable if we do a good job to somebody seeing us. I make the point clearly, like, we are viewed as a platform asset. If you want entry into Australasia, what probably happens is you say, hey, that looks like an interesting market, should we go and have a look? You come down here, you look around, and you see what we see, or I've seen and team's seen, which is it's not really that sophisticated versus what's going on in the rest of the world. It's quite unconsolidated. That sounds like an opportunity. Then you quickly look around and go, well, I wonder who I could buy. And there's not going to be many people that would be potential candidates. So yeah, it's a real and present risk. But obviously, it's not something we control, nor spend our time particularly worrying about. We're focused on building a business.
Well, Dennison, just finally, you did say, but just summarize next 6-12 months. What are your priorities?
Look, the really big one is with these acquisitions away, we're focused right now. We're very focused on integration. So the team is working, at a significantly fast level to integrate and to be successful and to bring those teams and people and contracts in. And I'm really, really wrapped with how that's going. What we have acquired, we've been very lucky to acquire, and we're very grateful to the teams that have come over, and we're looking forward to getting into that. The really next big thing though is the refinance. And so, I think that really is the maturity step for us as a business to really mark the end of the, coming off being essentially a scrappy little business, and having to find our way to capital and through acquisition and value and all that, to actually being a really stable, solid, end-to-end, business, the refinance. So we have engaged, as part of this quarterly report, we've announced we've engaged New Capital as a debt advisor to kick the work underway for the refinance. First window I've said openly, February next year is the logical one financially, but we will look to see if we can speed that up. I'd like to get it done, as soon as reasonably possible. And we will definitely be looking for senior secured bank debt, nothing ritzy, and nor do we need it. So, I think that's probably the next thing for people to look out for and to get excited about.
Good to speak, Dennison. Thanks very much.
Thank you.